Rahul Magan here is the Chief Executive Officer of Treasury Consulting PT Limited, and today we would be covering a very technical topic, which is fundamental review of trading book, trading risk architecture. Now this is a very important topic from a bank's point of view and all financial institutions which are in US and Europe both. As we very well understand that on a whole planet basis, we have faced a lot of things. Example, 2008 financial crisis. Few days before 2008 financial crisis, Mr. Greenspan, who then used to be the head of Federal Reserve, said that there's nothing wrong in the system and everything is going on an autopilot mode. Not sure what would happen. What happened a few days after, and autopilot was gone, so is the flight. Right? The world was converted. The world was a freezed economy. Nobody was lending to each other, and for that you should watch a very good movie on the Hollywood, which is the Margin Call movie. You will get to know how actually it would happen. It's a very recommended movie. In our training programs, we show them, which is Margin Call. It's a Hollywood movie. You will get on the torrent, not a problem. After that, there are a lot of regulations came, like Dodd-Frank came afterward, Volcker came afterward, proprietary trading desk comes under scrutiny, and hell lot of things which came after that. But unfortunately, the end result was nothing. After every 2 years, we are facing the same issue again and again, because things are not fixed. They are just they're just fixed for a moment and let it happen again. It might be politics, and after that I do not know. The 1st January 2018, everybody was expecting about MiFID second. I was also very bullish about MiFID second, that MiFID second would come practically 3rd January 2018. 3rd January 2018. I was also bullish that MiFID second would come. Markets in Financial Instrument Directive second. It would change the pre-trade compliance, the post-trade compliance, the pre-trade analytics, the post-trade analytics, and it would change a lot of things. ISIN identification. ISIN stands for International Security Identification Number, and everything would have changed. But unfortunately, it's being 5 months. Not being 5 months because May not yet over, because today is the 16th of May. Unfortunately, if you get the reports, I don't know how many readers are watching Bloomberg TV and Reuters and all, but if you see that, you will get to know MiFID second is a failure. And I'm not feel shy saying so in the public domain, because this is in the public domain. Traders are reluctant accepting the MiFID second. They're not pretty happy with MiFID second. The rules which being framed out are not up to the mark. Now this is the same thing with the fundamental review of the trading book also. I'm not against fundamental review of the trading book. There might be many people who might say that I'm speaking from the bank side, but I want you to tell them I'm not speaking from the bank side. I just wanted to convey that, boss, there are a lot of things which regulators never thought. Now, first mistake which we have in the fundamental review of the trading book is that a regulator wants a book has to be divided into 2 parts. One is the bank book, one is a trading book. Now, I wanted to let people know that Volcker was also the same. You did nothing but the copycat the Volcker. Volcker was also the same, that Volcker said that what investment banking is one place, consumer banking is another place. So you should not mix. So investment banking has no right to take the money of the consumer banking and invest in the market, and if you gain, okay, if you lose, then you are gone. It is more or less same thing. Fundamental review of the trading book is saying that the bank book should be different than a trading book, and it more focused on the trading book. I wanted to let regulators know that in many situations such demarcation is quite possible, but in many situations such demarcation is not possible. The reason being, banks are using such derivative instruments, like I refer this word embedded, whereby segregating a host contract from the embedded contract is quite difficult, or it is subjective. Now, I see that everything is rosy, things are good, so on and so forth. You might not think so. So there are a lot of places where that apprehension is there. Again, there must be many people who will say that speaking from the bank's point, but being an ex-treasurer, I see how banks works. Another problem which we are going to be facing from a trading risk architecture side is that banks are not very well positioned, because practically speaking, fundamental review of the trading book would get applicable from 1st January 2019. Now we have not more than 7 months. I do not want it would turn out to be another MiFID second, whereby after 5 months in 2019, people cry that, boss, where are we? We are nowhere. Now, banks currently have these, but not all. Example, derivative books, products, deliverable products, non-deliverable products, pricing analytics, pricing libraries. How many banks do you know, those who have the two from the last? Pricing analytics and pricing libraries. We have banks like Goldman Sachs, Credit Suisse, JP Morgan, Standard Chartered, UBS, those who are working on a proprietary software models. They have their own proprietary models. But we have hell lot of banks, those who are working on Murex, Calypso, and there are multiple platforms with which they are using. Although I do not want you to comment that how individual platform is, but majority of the platforms are not capable enough for that kind of thing, which is pricing analytics and pricing libraries. And for a minute even assume that they are, then again it requires a huge extension. So whatever you have today, it requires a huge extension. Like if I speak from a Goldman Sachs perspective, they have their own FX engine. How many banks do you know worldwide? Forget India. How many banks do you know worldwide who have FX engine? No. Very limited bank, and Goldman have their own FX engine. More or less, you are moving towards MiFID second when you are forcing the bank to change their infrastructure in a very short period of time, which is quite not possible, which is next to impossible. And regulators are very adamant, just like Volcker, just like MiFID second, that no, boss, everything would happen, because they think that everything will change in a minute, in a days, or maybe in hours. Another problem, which is the trade life cycle management. Theoretically speaking, the regulator said MiFID second is here, so he will take care about the trade life cycle management, which is pre-trade and post-trade compliance. I wanted to ask them one question. When it comes to the pre-trade and the post-trade compliance, how many banks are actually on the electronic platforms, which shortly known as ECN? Electronic Communication Networks. I don't know how many people know Reuters. We have TradeWeb there, FX All is there from Reuters. In Hong Kong, Singapore, we have a company called Integral FX. On the contrary, when we talk about the Bloomberg, they have their own prop systems like EMSX, which is nothing but an MTF, execution management system. They have their independent OMS, which is order management systems. I just wanted to ask one question. If a regulator feels that trade life cycle management is quite easy, my question to them is very simple question: how easy? If you have a list of, take the list of 30,000 banks from the top, cover US, Europe and Asia Pacific region, including Singapore and India, say Thailand, Philippines and all, 30,000 banks. Boss, I can give you on writing on a fresh piece of paper, not more than 15-20% from the top, like Goldman Sachs and all, they have OMS, EMS and very well linked with ECM. Rest all from the below, they might not even know about it, but they're supposed to have compliance. How come? Nobody knows. Then it comes to settlement life cycle management, which is valuation of gains and loss in the PNL impact. Why I am referring to that, you must be surprised, because there is a very good thing which they have mentioned, which is PNL attribution test. Now, if I refer the PNL attribution test in a very layman language, because this is a very technical thing, there are two kind of tests also in PNL attribution test. Actually, this is being done by two ways, in simplistically, but to speak in a very layman, stress testing is all about how resilient is your balance sheet. PNL attribution test is all about how resilient is your PNL. Value at risk is all about how resilient are you if anything would have, if the confidence level would breach, which is generally less than 1%. Generally, some people take 5% also. Conditional VAR is what would if this condition breach. So this is nothing but, this is not new, but people have given it a fancy name, which is a PNL attribution test. Anyways, There are tremendous amount of securities which are lying in the books of the banks, trillions and trillions of dollars. Let me put a small case. According to so many research reports which are flowing right now on the media, because one of the very hot topic nowadays is that we are moving from LIBOR to SOFR. According to the media or the Google or the research reports which we have on the Google, approximately $350 trillion of derivatives are linked with the LIBOR, which would systematically transition to SOFR. You may refer our video, LIBOR transitioning, more videos on the way pertaining to that, don't be bothered. Now I wanted to ask one question. I refer 5 names: Goldman Sachs, Credit Suisse, JP Morgan, Standard Chartered and UBS. These 5 names, I'm sure that have more than 20% out of this $350 trillion, assuming this number is correct, which I do not believe. Reason? In 2008 financial crisis and somewhere in 2012, when there is a lot of heat came up, when people started accepting that LIBOR is actually a rigged interest rate. There were several reports were there that this is more than $1,750 trillion, which is $1.75 trillion. So I disregard this $350 trillion of figure, but anyways, even if we go with that also, my question is, how would you will do the PNL attribution if I go with the logic which is there in the media, that in the second half of 2018, the regulator in Europe, which is ESMA, European Securities Market Authority, will issue a comment paper whereby the intent is to initiate a transition in by 2021. So by 2021, the transition would be complete. So all this so-called $350 trillion of security transition would complete. Now my question to them is, FRTB is coming up in between when you will issue a comment paper and when that transition would complete. Because if I go with the ESMA website, the comment paper will come in the second half of June 18, and by 2021 the entire globe would be transitioned from LIBOR to SOFR, which would nothing but an OIS rate, overnight index swap rate. My question to them is, FRTB is come right in between them, and you have mandated that the PNL attribution test has to be there. Now when PNL attribution test has to be there, did you make sure that how you would be covering the PNL attribution test when we were shifting from SOFR to LIBOR? I have wrote this extensively at several platforms, and maybe after a few days I'm surely going to be writing on the LinkedIn, on my LinkedIn profile, but I'm not sure, how regulators would take it. Another problem which we have, which is a big problem, which if you would have read FRTB, which is this: single factor library and multi-factor library. When we talk about banks like Goldman Sachs, Credit Suisse, JP Morgan, Standard Chartered, UBS, Barclays, Deutsche, the list is tremendous, right? They have both single factor and multi-factor. They are taking positions on those financial models which are either single factor or multi-factor. I'm not sure how many people are well versed with financial models, but if you would know CAPM, capital asset pricing model, then this is a single factor model. If you're talking about frame of reference, this is a 3-factor model, and you have multi-factor model also. Now these single and multi-factor models are actually being devised. There is a pricing analytics on Reuters, on Bloomberg also, and sometimes they are proprietary also. So the people like Goldman Sachs have devised it. On the contrary, the banks are completely dependent upon Reuters, Bloomberg and all these kind of things. Reuters and Bloomberg refer this as a single pricing library and the multi-pricing library, which is mentioned here, but I refer this as a single factor and multi-factor. Now my question is, are they ready for that? I do not want it to name, but we have so many financial terminals across, whereby if you go to their pricing libraries, most of them are single factor models. Hardly you will get one model which is a multi-factor model. Hardly you will get. Are you ready with that? But the reality of the life is 7 months down the line, we are initiating FRTB, Fundamental Review of the Trading Book. And very important thing to wind up this video, is that at the end of the day, is not the end of the quarter, end of the day, you are supposed to give ES. ES stands for expected shortfall. So it's actually a revised methodology from VAR. VAR is value at risk. You are supposed to give expected shortfall and the PNL attribution test to your regulator, and they would continuously assessing you how is your trading book is. They'll continue to evaluate your trading book, whether you are creating a systematic risk or you are not creating a systematic risk, and so on and so forth. To cut the long story short, this initiative is a pretty good initiative. I do not want you to demean it. There is nothing to demean it. But at the same time, we also need to appreciate that when a regulator will take an initiative, he has to make sure that the relevant infrastructure should be there, which is not the case in case of fundamental review of the trading book. MiFID's second failure is again an example of the fact that the absence of that infrastructure can create a catastrophic issues compared to what you wanted to have a benefit. So rather than having a benefit, you might have lost it. But anyways, regulator do not want you to listen it. Last but not the least, I don't think how many banks are even ready for PNL attribution when we are moving from LIBOR to SOFR and so many changes are happening. How many banks even know how to calculate expected shortfall? How many financial terminals even have the pricers, those who even calculate expected shortfall? But all these would soon be a reality in 2019. Banks are crying every day before regulators, they are not ready. Sometimes banks have a fault, they do not want it to change. But more often than not, they cry for a right reason. This was about the video. As far as our company is concerned, Treasury Consulting PT Limited, which is a Singaporean based company, we are pretty much ready about FRTB. And hopefully by June, which is approximately 40-45 days from now, we would be having so many things from FRTB on our platform, on our websites, on the social media, and so on and so forth. But still, we invite you to visit our fixed income platform, which is www.fixedincome.global. It's already on the Google's first page. So you just open Google and refer fixed income platform. You will get fixedincome.global on a second rank on the first page of Google. Alternatively, you can visit Skype, which is Rahul5327, website www.treasuryconsulting.in, mobile 9899242978, email is rahul.magan@treasuryconsulting.in. Have a wonderful time, and there are a lot of videos on the way. Thank you. Have a great time ahead.